the MD of Kotak Mahindra Mutual Fund, joins in now. And the news is the markets are at the low point of the day. We've slipped 0.7% on the Nifty, 77.30. As we speak, while the Sensex has lost close to about 200 points. Hi Nilesh, afternoon. Thanks so much for joining in. Does it get a lot worse from here on?
We have seen one round of correction, and obviously after that correction, it doesn't look like that we will have another round of correction which will be as big as this. No one can predict the bottom of the market, but clearly at this point of time, it doesn't look like that we are going to see similar level of correction as what we have seen from the top in recent time.
Okay. Nilesh, hi. Good afternoon and good speaking with you. I remember a comment you had made during, the investor camp when we met a couple of months ago, where you said that one should make volatility your friend and, the prices of stocks may fall, but the value will not fall. And this is as volatile a time as we have seen in the recent past. So do you think that one should go out there and increase their exposure into a lot of the quality companies, a lot of the companies that are now 10-15% cheaper? Or do you think that in the course of the next 3 to 6 months, one will get better opportunities?
Sonia, it's very difficult to predict where the markets will bottom out. But certainly it has become cheaper compared to what it was, let's say, 1 month back. Now, some of this correction is happening because of the global reasons, and maybe some of the correction is happening because of the local reasons. Our monsoon for the month of August was dry at 22% below average. This is probably one of the worst August monsoon rain which we have got. The quarterly GDP number came at 7% against expectation of 7.4. Now 7% per se is bright, but against expectation it is underperformance. Some of the crucial bills which are required to push economic reforms like the land acquisition, labor reforms, GST, the market is feeling that we are not seeing any immediate result over there. So these are the local pain points which have resulted into one correction. It is also attributed to the global sell-off which we are witnessing in Chinese markets and some of the other markets as well. So our feeling is that the volatility in the market is going to continue. And since there is no scientific way of predicting where the bottom of the market will be, we will advise investors to do two things. One, put half of your investable surplus into SIP kind of thing, whereby you are putting some money every month. And balance half, try to invest into market on a day like today, where markets are in red, prices are falling, and the correction is giving you a great opportunity to enter. We certainly believe that today Indian market is cheap compared to what it was, say, a month or two back, and it still provides a reasonably good opportunity for investors if they can make volatility their friend.
Okay. Nilesh, we've seen relentless selling by the FIIs in the Indian cash market over the last 2 weeks. You've been in the US for the last 2 weeks. What's the mood there towards India, especially for the near to medium term?
So if we see the analysis of the FII selling, it's largely driven by two sources. One is the exchange traded funds, where probably retail investors around the world are looking at the headlines appearing in media, television, and taking a call that, oh, the global growth is slowing down, let me take my money out of equity. The second source of selling is probably coming from sovereign funds, which are now witnessing lower oil prices and the need to push up their domestic economy. Now, both these sources of selling are driven more by the local factors rather than by the India factors. We met certain global investors around the world, and clearly they are all watching India in the context of the world where China was one big avenue of investment for FII and FDI investors. They are realizing that here is a country where the volatility of stock market is fairly high. On a 1-year basis, Chinese markets are up 40%, and it is also down 40% from top. Compared to that, Indian markets provide far better return and far less volatility. In the midst of the crisis, Chinese regulators banned people from selling stocks if they were owning more than 5% of stock. There are more than 200 journalists who have been picked up for questioning, for writing, reports on selling in stock market. Now, this kind of reaction do create doubts in the minds of investors, and compared to that, Indian stock market provides a far better opportunity. Even at the worst of the crisis in 2008, we never told any foreigner not to sell their shares. We allowed them to take their money out. So over a period of time, we believe these factors, apart from our economic fundamentals, will continue to assure foreign investors. While there is a selling from the ETFs and sovereign funds, we are seeing flows into our offshore funds from institutional investors. And that behavior gives us confidence that yes, in the near term, selling led by the, let's call sovereign funds which have domestic compulsions, and the ETFs which are more driven by retail or inexperienced money, may probably continue to see some amount of selling, but the smart money, the institutional money, is already moving into Indian stocks.
Okay, that point is taken. By the way, just take a look at the market now. In the last 10-15 minutes, there's been a sudden collapse on the index. The Sensex is now down almost 260 points, and the Nifty is threatening to give up on that 7,700 level as well. And all of this has been very sharp and swift in the last 10-15 minutes. The two stocks that are dragging the markets now from the heavyweights are HDFC and ONGC. So just take a look at those two heavyweights. Both of them are now down almost about 3.5 to even 4% on some of them. So as you can see, there's a sudden collapse that we've seen in these two names. Keep an eye out on that 7667 level. That's the lows that we hit this week, and the market at this point is threatening to break 7700 on the Nifty. Nilesh, I take your point about the fact that India could emerge as a relative beneficiary because of the falling global commodity prices. But don't you think that the worsening of global growth as a whole could impact the earnings, and then that will have to be factored into our market now?
So the last year we saw rupee appreciating against majority of currencies like yen, euro and GBP. It also depreciated probably lowest against dollar compared to other emerging market currency. Against that kind of pressure, our economy still continued to grow and our earnings still continued to grow. Now this year we are saying that the global growth is slowing down. But it's slowing down more in China rather than America. The US second quarter GDP came at 3.7%, which is ahead of market's expectation. With China, we are running $38 billion trade deficit. Now, if China is slowing down, hopefully this trade deficit will come down. And if US is growing ahead of market expectation and we have better business relationships there in terms of our software exports, in terms of our other merchandise exports, then we are going to benefit from that. So even in a slowing world, impact on India should be minimal considering our trade pattern. The second thing to notice is that why is world slowing down? It's slowing down in one segment of the world which was commodity producing. So countries like Australia, Norway, Middle East, where commodity production was giving growth, that has started slowing down. Now the benefit of lower oil prices, lower steel prices, lower metal prices should be felt by people who are consuming commodities. And we are one of the countries where we are consuming commodities. So as the fulcrum shifts from commodity producing nations to commodity consuming nation, we will be beneficiary of that, and hence the slowing global growth should not have as much adverse impact on our market as compared to rest of the emerging markets.
Nilesh, we've also given relief to foreign investors on the MAT issue. Do you see this boosting investor confidence in a big way?
I mean, if we see in real sense, we have never taxed any foreign institutional investors. We just issue notice, and thereafter when we see our market correcting, we immediately take steps to take back those notices. And this has been happening time and again. Every time, tax authorities have tried to send notice to the FIIs, the stock markets have corrected, and the same tax regulators have withdrawn it back. This time also we have repeated what we have done repeatedly in the past. So I don't think so it's going to give any particular assurance to an experienced investor in Indian market. This is what has been repeating on a time and again basis.
Okay, well, watch out for that 7,700 mark. It looks like it could give way any time now. So it's gotten quite worse in the last 10-15 minutes. Look at the chart of BHEL. That one has completely collapsed. It's down about 5.5%. But even some of these other charts that have been weak have seen incremental weakness in the last 10-15 minutes. Take a look at M&M. It's now down almost about 4%, down almost 8% this week. Of course, these are not the heavyweights, but then from the heavyweight list, as I was mentioning, ONGC, HDFC are the two stocks that are under quite a bit of pressure at this point in time. 7704 on the Nifty now, so that psychological level as well is going to give way pretty soon, or so it seems. But Nilesh, what about some of these sectors that have been doing well, the likes of pharma, IT, etc.? Do you still see scope there? And what are the 2 or 3 sectors that you would be bullish on from say a longer term point of view?
So clearly today we are seeing a diversion among the stock market where some of the sectors which are more linked to the global growth or which are linked to the infrastructure spending, I mean, they are all coming under serious pressure. The metal index has lost about 40% over last 1 year. Real estate and infrastructure and power are also in similar ranges. Obviously, investors are today not willing to take the risk of investing into leveraged companies. They are not willing to take the risk of investing into sectors which are open to government policies and regulations, or sectors which are getting, the hammering out of the commodity price drop. Now, since large portion of these sectors are moving away from the investor's horizon, the money are flowing towards sectors where at least some amount of visibility in earnings terms is available. And beneficiary of that we are seeing in pharma, technology and consumer staples sector. And my feeling is that notwithstanding the valuation, as of today, this trend is likely to persist. It's unlikely that investors will have courage to catch the falling knife in metal and power and real estate and infrastructure sector. People will be more than comfortable to put money into defensive sectors like pharma, consumer staple and IT and technology, where at least you have the comfort of earnings visibility notwithstanding the valuation.
Okay, just for one tick, the Nifty breached the 7,700 mark, but even now it's hovering at those levels, and many mid-caps are coming under severe pressure. The index itself, the mid-cap index, has dipped into the red, and the advanced decline ratio is now well in favor of the losing side. But look at names like a Bharti Infratel. Now that's lost ground in the last 10-15 minutes. A PFC, JSW Steel. You can see vertical slides in many of these mid-cap linked names. Nilesh, up until now, when the markets have been falling from levels of 8,400 to now 7,700, we've seen the DI support the markets, match the FI selling to a great extent. Do you expect this DII support to continue? At what point will the retail investors get perturbed by this kind of volatility?
I think the retail investors have matured sufficiently. A lot of financial advisors have played a stellar role in educating retail investors that volatility is part and parcel of equity investment, and a correction in a fundamentally better market gives a great opportunity to make money rather than lose money. So my feeling is that based on our interaction with financial advisors, financial intermediaries and investors, they are today reasonably confident about India growth story. Obviously, they are worried with the drop in the market, but they have continued their investment. At the time of maximum correction, we are seeing good flows into our equity funds, and that gives us confidence that the support of domestic retail investors will continue. Last year, we have invested about 65,000 crore in equity market, all the mutual funds put together. This calendar year, year to date, again the run rate is about 45,000 crore, and we still have some months to go. So it gives us confidence that retail investors will continue to grab this advantageous opportunity in a correcting market. Valuations are becoming fair, fundamentals are reasonable, and yes, we will see higher volatility, but these corrections are giving great opportunity to buy good companies at lower prices. So we believe the domestic institutional investors will continue to participate in the market, and they will probably help make bottom of this market.
But as an asset class, Nilesh, do you think equities might lose a bit of its luster for the next, say, 6 to 12 months? Because if interest rates, continue to fall as is expected, do you think some of these long duration debt funds could give you better opportunities than equities in the next, say, 6 to 12 months?
So if I see 40% correction in gold prices, it has not reduced luster of gold. Our imports continue to be as strong as they were when gold prices were high. So clearly investors don't necessarily change their perception in relationship with corrections or in relationship with volatility. It's all about habits, it's all about education.
No, my question
Today
was
more than...
I understand that. My question was more, as to which asset class will give you a better return in the next 6 to 12 months between debt and equity, because debt is looking slightly more attractive now.
Definitely, I was coming towards that.
Sure.
On a 6 months basis, probably debt fund and equity funds returns will be similar. But if you take an 18-month horizon, equity funds will start outperforming debt funds by a significant margin. Now it all depends upon how you can take the advantage of the volatility in the market. So on a 6 months basis, probably debt and equity funds will deliver similar return, and debt funds returns will be supported by the rate cuts which are expected over next 6 months. But over 18 months, equity funds will outperform debt funds by a significant margin.
Okay. Nilesh, one final question. When you were talking about sectors, you said that investors may not have the confidence in sectors like real estate or metals, while defensives like IT, pharma, some consumer names look quite good. Where does private sector financial names fit in? Because we've seen corrections of more than 20% in blue chip names like ICICI Bank.
I mean, clearly today private sector financial services company have to recognize the fact that the Reserve Bank of India, by introducing base rate which is linked to marginal cost of funding and not to the total cost of funding, is changing the way this banking sector is going to behave. The profitability of private sector banks, profitability of the entire banking sector, be it private or public, will come under pressure if this transmission happens. And that needs to be recognized into the valuation, which means now the banking and financial services sector becomes far more bottom-up stock picking rather than top-down stock picking. So clearly this is one sector where today we have to see how the draft guideline issued by RBI gets converted into law, and how does it impact or alter the profitability of the banking sector. So it's a wait and watch over banking and financial services. We hope that the changes are more gradual in nature and does not alter the profitability of the banking sector by a significant margin.
All right, Nilesh, we leave it at that. Thank you for taking your time out at a very volatile time like this. That's Nilesh Shah of Kotak saying that make volatility your friend, and this is the time to buy the market and not fear it. But let's get an insight into the dealing